Thank you all for coming back. And I know it's been a long day, but the fact that you're here shows your interest in the subject. As I said earlier, for those of you who are not here, and for those who were, you can hear again, we are now going to switch from analyzing markets and risk-return trade-offs for risky debt securities. We're now going to shift to analyzing companies and the assessment of a very important variable, namely the probability of default. And as Professor Walter introduced, I have been studying this subject for about 100 years. So I was 7 years old when I built my first model. So I'm 107 now. I know you're supposed to laugh. You're supposed to laugh a lot. It is true that we built this first model more than, or about 50 years ago. And usually in econometric models, they don't last very long. And a new model is introduced to hopefully improve. Well, this model has lasted 50 years and is available on many software programs. Do you have in Korea Bloomberg machines? Some of you have Bloomberg. Well, you can get the Z-score model from Bloomberg. And he made billions and billions of dollars with the Bloomberg terminals. And on the Bloomberg terminal, you have the Z-score model. And I'm told there are about 5,000 hits per day. Mr. Bloomberg's very rich. He gives a lot of money to charity, but he's very cheap when it comes to paying me. So no, I don't get anything for it. Just 1 penny per hit would be okay. But I'm only kidding. But I do find that what I'm saying is this model has been around. But let's go through the evolution of scoring models, including we will talk a little bit about Korean models. And as I mentioned earlier today, we're also going to introduce the Korean model and see how it has worked a little bit over the years since we built the model in 1995, when I did some work with some Korean professors here. So, scoring models. They have been around a long time in various forms. And systems started in early 1850s, 1900, mainly using qualitative factors to evaluate the creditworthiness of individuals and companies. Then, about 1909, we had the introduction of rating agencies. Moody's in 1909, Standard & Poor's in 1916, and they introduced, along with some other companies, accounting and later market measures of financial risk. Now, many of you have studied either in universities or in companies or reading about financial ratios, measures of performance of companies, profitability, liquidity, leverage, activity, many of these measures for assessing the credit worthiness or health of companies. And those measures were standard tools and are still being used today in a very traditional format. So for example, ratings. These are qualitative ratings, but they are based on usually quantitative statistics on companies. So for example, here is a table that shows for Standard & Poor's, you have a number of financial measures: EBITDA margin, return on capital, interest coverage, and so on. And we have the median, or 50th percentile amount for AAA, AA, single A, and so on. Now, when a company wants to raise money through the debt markets, they usually hire an investment bank. And that investment bank is usually their representatives when they go to the rating agency to receive a credit rating. And a company, of course, will be interested in what rating they will get, because that will help determine the cost of debt capital. And when you combine that with the cost of equity capital, you get something called the weighted average cost of capital, which is kind of like the cost of financing for the company, to be used as a benchmark against investment strategies. So it's a standard investment decision comparing the return on investment with the cost of capital. So the rating is very important for determining the cost of debt. So they ask the investment banker, what rating do you think I will get? Or perhaps they already have a rating and they're issuing more bonds. And they want to know if by issuing more debt, their rating will change or not. So, for example, we look at the median level for AAA, AA, etc. companies. Incidentally, in the United States today, we only have 3 companies left with a AAA rating. We used to have 15 or 20. Now only 3. Microsoft, Johnson & Johnson, and ADP. No longer even oil company AAA, or pharmaceutical one, Johnson & Johnson. So it's very hard to get AAA rating. And so AA is usually the highest. And as I mentioned earlier, we have from AAA down to CCC. And so one way of estimating the rating is to see how you compare in terms of traditional ratios. And matrices like this for the US, or similar breakdown for Europe, Middle East, and Africa. But I have not seen a breakdown for Asia, or for Korea, for example. But I'm sure you can do it. I don't know if you have come across this here, but I have not seen a similar matrix for Korea. But this is what's called traditional financial statement analysis. Very common, very traditional, and not very difficult to understand. But if you go back to the third bullet, around 1965, 1966, we were the first to introduce the concept of multivariate models for credit risk assessment. And the idea was very simple. Can we enhance, improve the information content from financial data in order to predict the bankruptcy or not of companies? And that was my objective when I did my first research almost 50 years ago. And those models have now been proven to be very effective, not only for outside analysts for companies or rating agencies, but some of you have heard of Basel II and Basel III. In 1999, Basel, incidentally, Basel is a city in Switzerland. and there's a circular building near the railroad station called the BIS, Bank for International Settlements. And there they have representatives from all over the world doing research on bank regulation and bank safety and bank solvency. And in 1999, they issued the first draft of Basel II. Basel I, vintage 1988, said banks need to hold 8% of their exposure in the form of reserves against expected and unexpected loss. One size fits all, without differentiation by risk. Basel II said, no, that was incorrect. Now we're going to recommend that banks hold capital based on how risky their investments are. What is the probability of default and the probability loss of lending money to companies, to sovereigns, to individuals? And the number one tool they recommended using was credit scoring models. So now just about every bank in the world, particularly large banks, has internal rate-based credit scoring models. How many of you work for banks? Raise your hand. Okay. Does your bank have a credit scoring model? Yeah. Does your bank? Especially if they are big. And the prototype model that all banks originally looked at was our Z-score model, which we developed in 1966 and published in 1968, 50 years ago. Now, I will explain the evolution of these models in a moment, but the techniques that we used were discriminant analysis or logit or probit. These are all variation on the same theme, using a number of financial indicators simultaneously and establish weightings for each of the variables in the model, combining those to come up with a single score as the credit score of a company. And that was done, as I said, in the mid to late 60s, and it's being used for consumers. The original Z-score model was built for manufacturing companies, publicly held, US. That was the first model. Since then, we have built models for non-manufacturers in many other countries, including Korea. I personally have built models in Korea, Canada, Brazil, France, Italy, and Australia. 6 or 7 different countries. But I think now it is such a standard technique that just about every major and some minor countries of the world have Z-score type models built based on local data, local bankruptcies, and local accounting numbers. Then there were some attempts to use artificial intelligence. Can you teach a computer how to do credit analysis in the same way you teach it how to play chess, for example? Now it's pretty clear that a computer can outplay human beings in chess. Can a computer do a better job on assessing the credit risk of companies? I don't think so. But you could train a computer to do what an expert does. The problem is there are very few experts out there who are experts all the time. And maybe we can use statistical techniques to improve upon what individuals do in this artificial intelligence. And there have been option contingent claim models. For those of you who have more of an academic background, one of the Nobel Prize winners in the past, Robert Merton, built the first generation option contingent claim model. And basically the idea was very simple. The company has a certain level of assets and a certain level of liabilities. And you try to assess the probability that the value of those assets will fall below the value of liabilities. Very simple idea, assets versus liabilities. But not in accounting numbers, but in economic value. And so we have what's called structural models. But these are very expensive. The commercialized value name for one of these models is called KMV. How many have ever heard of KMV? Anybody here? 1, 2, 3, 4. Who owns KMV now? Anybody know? Moody's. Moody's bought KMV in 2001. The idea was if you can't beat them, buy them. Yeah? And that's what they did. But very few companies use KMV. You need an efficient stock market. You need very good data on volatility. And you need a market that is fairly efficient in terms of the stock market's valuation of a company's future value. And Basel II suggested hybrid models, combining accounting measures, market value measures, and macroeconomic variables, combined into a single model. So let's take a look at the evolution of these models and go back to when I did my first research. So I was looking for a doctoral dissertation topic. And my professor left a single piece of paper on my desk one morning with the word bankruptcy. What did he mean? Well, he wanted me to do some case studies of companies that went bankrupt. And I did. And I said, boring, not so interesting. But what about building a model to predict bankruptcy? That was exciting to me. And I was very lucky because I was born at the right time. And I went to UCLA at the right time, 1965. Why was it the right time? Well, you may not remember this or heard of it, but around that time was the beginning of what's called mainframe computers being available for research on college campuses. Now, of course, you don't need a mainframe computer. You just download a statistical program onto your PC. In those days, the way you did research was you gathered the data, you punched it on what's called punch cards. You ever hear of a punch card? Anybody? You never. You're too young. You're an old guy. Not as old as me, but anybody else? What punch cards are? These cards that you punch the data, you combine it with a source program, put it in a box, carry it across the campus. It's good for bodybuilding because it was heavy. And you submit it to the mainframe computer. And then you go to your church, synagogue, mosque, Buddhist temple, whatever, and you pray. You pray for results. Many times your prayers are not answered because one of the cards was bent a little bit, or you punched the data on the wrong column. And it said, sorry, try again. And so you had to do it again. But I was lucky that there was a mainframe computer to do statistical analysis. And second, there was a statistical program called discriminant analysis, available for the first time in the social sciences. It was a derivative of medical sciences that had been used before. And if I'm convinced, if I had been at the university 2 years earlier, without the mainframe, I would not be able to do the analysis. And 2 years later, somebody else would have done it. So that's what I mean about being in the right place at the right time. Anyway, at that time, the traditional analysis was univariate, one measure at a time. Well, you can do univariate analysis. And how do you do traditional analysis? You look at a number, like return on assets, current ratio, debt-equity ratio, and you compare it with peer group, other firms in the same industry. Or you compare it over time, trend analysis. And then you make some sort of evaluation. Well, let's suppose you have 20 or 30 or 40 financial measures that you calculate. At the end of the day, there's no definitive answer as to whether or not that company will pay its debts on time. But your boss says, I want a decision by 5 o'clock. So how do you make a decision? Most people use subjective weights. What is a subjective weight? It is a weight that you as a decision maker use based on your experience, who you studied under, the books that you've read, training programs in your company. And subjective weights, therefore, are very much a product of who does the analysis, when they do it, who they are, what was their experience. Now, if you are brilliant all the time, you probably do a very good job. Very few of us are brilliant, and almost nobody is brilliant all the time. And so the question that I was trying to understand was, can we substitute subjective weights with objective weights? Weights that you and I would come up with if we had the same data and the same computer program. There's no subjectivity in the weightings. What there is subjectivity is how we construct the scientific investigation. And I will explain how we did it in the US, in Korea, and in 5 or 6 other countries. And indeed, we are doing it today in Italy. And we are building a model for evaluating the creditworthiness of small and medium-sized companies in Italy for a market called mini bonds. You've probably never heard of mini bonds. But these are bonds issued by small and medium-sized companies directly into the market, generally between 5 and 30 million euros in size. And we are trying to build a scoring model to give some credibility to the risk evaluation of SME companies, which up to now have only had the ability to raise money from banks. And we are trying to substitute capital markets for the banks in some cases. So finally, in 1965, we had the problem of ambiguity. What happens if one measure is pointing in a good direction and another measure is pointing in a bad direction? What do you do? And what about misleading information? That's where the ratio is pointing in one direction, but the company is going in the other. I'll give you an example. Did you know that more than 50% of companies that go bankrupt actually have an increasing current ratio just before they go bankrupt? Current ratio is current assets divided by current liabilities. It gets better, in quotes, as the firm gets worse. Why? Inventories that they can't sell, receivables that they can't collect on. And so we could be misled by individual measures. But when you combine it, it's less likely that you are going to be misled. And that's what we did in this building of this model, using a technique called discriminant analysis. So notice the form, Z. Incidentally, I could have called it A, B, but I called it Z. Why? There was no good reason. But now it's called Z. And you can look up on Google search, Wikipedia, wherever, and put in Altman Z or Z, and you will get the model. So, for better or for worse, we called it Z. And Z is a very common statistic in the field of statistics. And Z is equal to A1x1 plus A2x2. The A's represent the coefficients or weights, and the X's represent financial variables that we have identified that could help predict bankruptcy. Now, we started out with a very small sample of 66 firms, half bankrupt, half non-bankrupt, all manufacturers. And we looked at about 22 financial measures. From the original 22, we ended up with 5. So these 5 measures were the original Z model variables. Now, I want to repeat, there is nothing magical about these 5. But combined, we were able to get a very high level of what's called classification accuracy. We were able to predict which firms went bankrupt and didn't go bankrupt based on the original sample of manufacturing companies. 5 variables. Let me go through them very quickly. First variable, working capital divided by assets. It's a measure of liquidity. Working capital is current assets minus current liabilities. Assets is the size of the company. How much liquid assets they have relative to the size. It was the least important of the 5. The least important. But it did help somewhat. Second variable, retained earnings to total assets. We had never seen this variable before in the literature. So think for a moment with me. What does the retained earnings of a company tell you? What is it based on? By the way, it's the balance sheet retained earnings, not the income statement. What does it tell you? Do you remember? What do you think it tells you about a company's history? Well, let's go. Tell me. How much money they've made over their entire life, cumulative profitability minus what? Dividends. How much they paid out to shareholders. So cumulative profits minus dividends, it's a measure of internal financing relative to the size of the company. So the company that has had a large amount of profits and has not paid out too much in dividends has a lot of retained earnings relative to assets, therefore has a built-up big debt capacity because it has not used up to then OPM, other people's money. They finance the operation internally. So it's like a backdoor measure of leverage. How much debt capacity could they use in the future? Also, it is a measure of the age of a company. Think about it. The young company that has been in existence for maybe 1, 2, 5, 10 years, startups, usually has negative profits or very low profits. And so it has not had time to build up its retained earnings. And, of course, the probability of default and bankruptcy of young companies is much higher than older companies. And so it's a good measure of age. But we would never capture the bankruptcy of General Motors, of Chrysler, of Kia, when they went bankrupt in 1998. 7 Turbos went bankrupt. They were all old companies. No model with age as a specific variable would probably have predicted 7 Turbo bankruptcies in 1997, 1998. Third variable, EBIT to total assets, a measure of profitability unimpacted by taxes or leverage. Now, you may say, well, taxes are important. Interest is important. I agree. But I want a measure of profitability that is pure. In other words, let's talk about the pure earning power of a company. Now, pure is certainly a little extreme when it comes to accounting measures, but we found that this measure just as accurate as cash flow. Bankers love cash flow. But I didn't have, when I built this model, it was prehistoric times. Very primitive financial statements in the 1960s. I mean, just think about Korea in the 60s. What sort of financial analysis was going on then? Almost nothing, probably. You know, it was a pretty rural environment. The US wasn't much better. Yes, we had rating agencies, we had audited financial statements, but the data was, especially for smaller companies, was not that great. Fourth variable. For the first time now, we have a measure that uses market value data. Market value of equity divided by the total liabilities of a company. So let me ask you a question. Most financial analysts use book value of equity. Which do you think is a better indicator of the future health and creditworthiness of a company? Market or book? And why? How many think market is a better measure of equity than book? Raise your hand. Market. Okay. How many think book value is better? Okay. And how many don't think, right? We said that before. And yet, most financial analysis, not textbooks, tend to say book value. And the reason is either they don't trust market value, markets are not efficient, and certainly markets are much more volatile than book. So the question you might also ask is, do you want a measure of creditworthiness to move on a daily basis, up and down, as the market value does? Book value doesn't change at all until the next quarterly financial statement. But what does market value capture that book value does not? Tell me. Future expectations, cash flows, profitability, risk, all included in this concept of share price. Market value of equity, future, Book value, historic. Market value of equity, a measure of the cost of equity capital of a company. Market value of equity, looking at the creditworthiness. You know, it's very strange, but when I check with Bloomberg about those 5,000 hits a day on Z-score, they said most of them is coming from analysts who are interested in equity valuation, not debt valuation. And I was very surprised about that, because I thought that Z-score, bankruptcy prediction, was much more relevant for debt analysis. No, they said, more people are using it for equity. So I was surprised about that. Incidentally, if you're calculating it yourself, be careful. Those of you who have a pencil and paper, please write down the following. 20 divided by 100. I'm serious. Or put in your mind what the answer is. 20 divided by 100. How many of you have as your answer? Oh, by the way, if you need a smartphone or a computer to calculate the answer, take your time. How many of you wrote down 0.2? Raise your hand. 0.2 or 0.20. Okay. How many of you wrote down 20%? Most normal human beings write down 0.2. If you're a little strange, weird, like I was, you write 20%. But the computer is really stupid. It will analyze whatever you put in. So if you're normal and you write 0.2, use the second equation. If you're a little strange and you wrote 20%, use the first equation. But they are identical, except for the fifth variable. Sales to assets is always in number of times. So if sales are 1,000,001 and assets are 500,000, 2, not 200%. And then you multiply the two together, sum it up in a linear to get the Z-score. When we built the model 50 years ago, we knew that the reader of the article and the books that followed, we knew that they would need some guidance as to what the score means. I mean, what does a score of 5 mean, or 3, or 0, or 10, or 100? All we knew, based on the model, is the higher the score, the more creditworthy the company. But it gives us no indication of probability of default, which is what we were really after in our analysis. So as a first indication, we established the zones. And if you look it up on Wikipedia or Google search, you will find these zones. And any score, when we built the model in 1968, with a score greater than 2.99, was in the safe zone, meaning no one went bankrupt. Any score below 1.8, everyone went bankrupt within 2 years. And in between was somewhat of a gray zone. Well, that's what the results were based on data from 50 years ago. Today, those zones are no longer as relevant. But they're in the literature. They're on the internet. They're in social media. And so they have a life of their own. And people still believe in these zones. I get calls all the time, or emails, saying, our firm has a score below 1.8. Are we going bankrupt? Or, we can't get any credit because the bankers all say we're going bankrupt. I said, they're not using it correctly. But that's what it was 50 years ago. So let's see how the scores have evolved over 50 years to see maybe we can get some more meaning. And so we have, estimating PDs based on a scoring model. Incidentally, every bank in the world is doing this. Now, they are not necessarily using z-scores, but every major bank in the world has what's called an IRB, internal rate-based model, because that's what Basel suggests. Now, most banks, their models combine quantitative and qualitative variables. A good question for banks are, what's the relative importance of quantitative versus qualitative factors in determining creditworthiness? I'll give you an interesting true story. I was giving a lecture in Brazil many years ago. I'm going to come back to Brazil at the end because we're going to talk a little bit about sovereign risk. And Brazil is way up there today in terms of risk, and by our model as well. And I was asking this question of the chief risk officer of these banks. How important are quantitative versus qualitative variables? And there were about 8 banks in the audience, and a lot more people, but only 8 CROs, and they all gave me the same answer, 70-30. 70% quantitative, 30% qualitative. I said, how could that be? How do you all agree? There's only 2 possible reasons. One, it's the right answer, and you all got the right answer. Or there's a little consultant whispering in the ear of the CRO of every bank, 70-30. And so one of the banks hired me and my team to reverse engineer the scoring model. And it turned out it was not 70-30. It was 50-50. So they liked, at least the Brazilians did, like qualitative variables, such as quality of management, industry, size, age, things like that. But that is step 1. Build a credit scoring model. Step 2, establish a bond rating equivalent of the score. And this is going to be a function of when you do it. 1968, 78, 88, 98, 08, 2016. It's going to change over time. For example, we've looked at this phenomena at least 5 times. What this shows is the median z-score by credit rating. There's some very interesting data here. What's the average z-score today of a B-rated company? How much? It's not rocket science. How much? This young lady. What's the average for B today? 1.66. Remember the zone? That would be in the distress zone in 1968. But today, it's the average B. And there are more Bs than any other high-yield bond. And second only to triple Bs of all bond ratings in the US. So B is a very common. Will all Bs go bankrupt? No. I think it was William Shakespeare who said, a B is a B is a B. No, I'm only kidding. But in fact, all Bs are not created equal. And certainly all Bs do not go bankrupt. Remember the data I showed you earlier? What's the probability of a B going bankrupt or defaulting for 5 years? Anybody remember? 28%. That means 72% of Bs last at least 5 years and don't default. And of course, you're collecting the coupon. and you're earning the spread for 5 years, and then you have the trade-off between the risk and return. And then you have to factor in recovery rates. So it's all quite scientific when you look at the numbers as to what the bond rating equivalent is of the model and what does that bond rating equivalent mean. Well, we're going to transfer the bond rating equivalent into utilizing mortality statistics in order to establish marginal and cumulative probabilities of default. And I showed you that matrix earlier. Let's see it again. Okay. We update this data every year. We've been doing it since 1989. This is based on more than 1 million bond issues, almost 3,000 defaults. As I said earlier, we are very fortunate in the United States. We have many recessions and lots of defaults. And when you have a lot of data, you can build models and test them. And the bond rating equivalent actually has meaning. And so I can put a PD, probability default, next to a Z-score because we have the intermediate step called bond rating equivalent. Now, it's not 100% accurate because 40 years of financial data is not necessarily what's going to happen next year. Remember the old statement, this time it's different. And if the Federal Reserve and the Bank of China and the Bank of Japan all say, we do not like defaults, we will do what we can to pour liquidity into the system so that there will be easier turnaround strategies, bailouts and the like, then maybe historic data will not predict the future as well as it might have without central bank interference. My feeling is, however, we are building a bubble in debt markets. And that bubble is partly a function of the amount of liquidity that's being poured into the system artificially by central banks. So we've got this PD now, and then finally we estimate recovery rates to get LGD, loss given default. Let me give you some quick case studies. I want to do maybe 3 of them to show you how we use the model, and then we'll turn to Korea and our Korean model. This is a company called LTV. LTV was a large steel company in the United States. Its score dropped into the distress zone, or a B- equivalent, in 1982, and then continued to deteriorate until 1986, when it was below 0, the score. Incidentally, as I showed you before, the average D, default company, has a score of about 0. So any firm with a score of 0 or below looks like a defaulted company. And the higher the score, of course, the higher the credit rating. Here we go, 6 months before the model was predicting a D rating. Now, sometimes when I give lectures on this subject, particularly to professional credit officers, they oftentimes say, oh, it's a nice model, Professor Altman, but you haven't told us anything new. We knew that company was a good company or a bad company. We knew Hanjin Shipping was a bad company. I said, oh, that's interesting. You knew it. What's wrong with a model that confirms what you know? So, okay, there could be some benefit in a confirmation model. And then I say, I know in some cases you didn't know. They get very defensive. How do you know what I didn't know? And I said, well, let's take a firm like LTV. 1 day before, 1 day, 2 things happened. The bonds were selling at 82 cents on the dollar. That is mildly distressed. If you follow the bond market, mildly distressed is like 10, 20% discount from par. Major distressed is about 60 cents on the dollar, and average defaulted price, 40 cents on the dollar. So 82 cents was mildly distressed. Also, one day before, a Wall Street analyst put out a buy recommendation on the bonds. Buy. One day later, the firm went bankrupt. The bonds dropped from 82 cents to 35. So you would have lost 50% of your money in one day. And the analyst was transferred from the New York office to the Siberian office of the investment bank. No, I'm only kidding about that. But he wasn't very popular. If he had an early warning system with only 1 day early warning, you could have saved 50% of your investment. So I know that early warning systems are important in some cases. Probably less so today than 50 years ago because markets are much more efficient, there's much more information. And usually when a company goes bankrupt, most people know that it's on the verge. Not always. Here's another company, International Harvester, now called Navistar International. This is a very different example. This is an example of something that I just read in the Wall Street Journal today about Chinese companies doing equity for debt swaps. So if you pick up today's paper, you'll read about it. There's nothing new. Basically, it's the idea when a firm gets into trouble, rather than go bankrupt, they do an out-of-court try to do an exchange offer, offering equity for debt to give the firm more time to restructure. Our studies show, by the way, that almost 50% of firms that do some sort of distressed exchange go bankrupt anyway. In other words, it's a Band-Aid that doesn't last very long. Because most firms that have trouble, it's not only the balance sheet on the right-hand side, it's the left-hand side also. It's the operational issues that cause bankruptcy as much as the financial issues. And we have an industry, in fact, I'm not sure if there's a Korean chapter, but anyone interested in consulting for distressed companies, there is an organization called Turnaround Management Association, TMA. And look up on their website, turnaround.org, O-R-G. And they have chapters all over the world. There's definitely one in Japan. There may be one in Korea, but Japan is not that far away for anyone interested in doing that. International Harvester. In 1982, the score was below zero, clearly in the distressed zone. I and a lot of other people were saying this $9 billion farm equipment, truck, and bus company was on the verge of bankruptcy. And they had a very poor operating strategy, but a very clever survival strategy, which perhaps you can understand when I tell you what they did was call together their banks from all over the world. You see this room? There's probably about 150 seats. Double it. That's how many bankers they had. Ladies and gentlemen, our firm has a problem. What is your problem? We cannot pay our salaries and our interest. We need your help. The bank said, what do you mean help? They said, well, that interest that we owe you, we are going to offer paying 50% in cash and 50% in preferred stock. Oh, this was 1982. Equity for debt swap. This was the first major company offering an equity for debt swap. Now we're reading about it in the Wall Street Journal in 2016 for Chinese companies. Nothing new, but can be effective. The bank said, okay, we'll give you 6 months. 6 months later, same 200-plus banks, same chief financial officer. Ladies and gentlemen, we have a problem. What do you mean, we? Well, you are shareholders now of our company, and we can't pay our interest and our salaries. And this went on for 2 years. And then you see 1986, the score jumped after they sold one of their divisions, the farm equipment division, which was the main problem division of the company. And the score went up. It's still pretty low, bond rating equivalent probably today BBB. Check it out on Google search or Yahoo Finance or whatever financial one you use here in Korea. You'll find its bond rating is BBB plus or B minus. Still in existence. The banks never lost any money. But they did a distressed exchange. So whether or not the model was right or not is an interesting question. I don't think it was wrong as much as I did back then. Let's talk about the US automotive industry. How many of you remember in 2008, the 3 big US manufacturers, General Motors, Ford, and Chrysler, all were in financial distress? And I had the privilege or the responsibility to testify before the US Congress asking the question, should the government continue to bail out General Motors and Chrysler? Ford was considered not as bad. And in early December 2008, I got a call to appear in Congress if I wanted to, 3 days later, to give my opinion. So I asked my graduate assistant to quickly calculate the most recent Z-score. And notice the Z-score on the right-hand side, GM, in 2008, December, negative 0.63. If I had the computer here, I'd show you with a cursor. But so you can see there, negative 0.63. Clearly in the distressed D zone. So I was convinced that the only thing that could save General Motors was to go bankrupt and to restructure. And this is very important, and I lecture this to my class all the time. Bankruptcy is a privilege, not a right. Bankruptcy is a way to prolong a company's life if it's bankruptcy reorganization, Chapter 11, not bankruptcy liquidation, Chapter 7. And under an 11, Chapter 11, a firm has much more ability to survive than under 7, or even bailout from the government. But the Congress, they didn't want to hear the B word. They did not like bankruptcy. Who would buy a car, they said, from a bankrupt company? And I said, why not? As long as you can get government guarantee on spare parts, warranties. I mean, you fly airlines that go bankrupt all the time. Every American airline except for Southwest has gone bankrupt. United Airlines, US Air, Delta, TWA, American, they've all gone bankrupt. And they're healthy today because they have restructured in bankruptcy. So I argued in December 2008, GM should go bankrupt and get a $50 billion DIP loan, debtor in possession. Does this exist in Korea? Let me explain. A DIP loan is where, after you go bankrupt, you can get money from banks and other institutions where the new loan has a super priority status over all existing debt. Is it possible in Korea? Is it possible for Hanjin Shipping to get a loan from, I don't care, what's your biggest bank now in Korea? What's the big bank here? Korea Bank. Which one? Kumin. Can Kumin make a loan to one of your bankrupt companies and have a priority status over existing creditors? No. It's possible in the US. It's possible in Japan. And increasingly, it's going to be possible in Europe, but not yet in other countries. You know, the legal system is very protective about creditor rights. But in the US, it's been felt for a long time, if a company is going to restructure in bankruptcy, it needs working capital. And how do you get working capital? You got to be able to borrow money. But who would lend money to a bankrupt company unless they were given a priority status? So I said they should get $50 billion from the government because the banks were all in trouble in 2008. Congress said, Altman, go home. We're not going to let it go bankrupt. We're going to give it a bailout. And President Bush, in the last thing he did, gave a $15 billion bailout to General Motors and Chrysler. And then he said, now it's Obama's problem. Absolute words he used. Now it's Obama's problem. 6 months later, the happiest day in my professional life, guess what happened? GM went bankrupt. My wife and I have this tradition of opening up a bottle of fine red wine every time there's a big bankruptcy. And if there are 2 or 3 big bankruptcies at the same week, we go to the fine champagne. Well, in 2008 and 2009, we were drunk all the time. It was a fantastic period. And GM went bankrupt in June 1st, 2009. We were drunk for a week afterwards. Because look what happened. This is the Z-score on GM. Chapter 11 filing, 6109, score was definitely below 0. Since then, it's gone up. Its score now is like 1.5 to 2. We think it's a B. The markets say triple B. GM is now an investment-grade company. For some reason, the Chinese love Buicks. I don't know why. But if you go to China, you'll see lots of Buicks. I don't know why either. We don't like Buicks, but the Chinese do. So GM is doing pretty well in China and a few other countries. But it's a much healthier company today because it went bankrupt. It's kind of ironic, a paradox, that bankruptcy can lead to a turnaround if it is structured very carefully. First, we have the scoring model, Z double prime. And we get a bond rating equivalent. And then we adjust the bond rating equivalent for 5 variables. First, we do what I said, get the score and give it a bond rating equivalent. Step 2, adjust the bond rating equivalent for, and this was critical in Korea in 1997, the vulnerability of the country to devaluation risk of the local currency. Do you know how much the yuan devalued in 1997? Anybody remember? Vis-a-vis the dollar? More than 50% in a very few months. Maybe it was 70%. How much? 100%. Yeah, so in half. That's what I meant by 50%. Yeah, you're right. That means if you owe dollars, before you own $1, now you owe $2. So how vulnerable the firm is very relevant, particularly in an emerging market. Now, what kind of company is most vulnerable? It's a company that has revenues in local currency and obligations in foreign currency. The more this ratio is unfavorable, the more the vulnerability. And so that should be considered a variable in how creditworthy the local company is, especially if they have obligations in non-local currency. And that's true today, just like it was then. Now, the Korean won probably has not devalued very much. But tell me, how much the won today, how does it compare with the dollar compared to last year? Is it more or less steady? Then you probably have relatively little across the board. But if you had a company whose revenues all were in dollars, like oil companies or forestry, commodities based, that's a lot less vulnerable than one that is like a local department store. So one of my PhD students at New York University was a Professor Young-Hong Yam, E-O-M. He's a professor now at Yonsei. Maybe some of you have heard of him. I actually had coffee with him earlier today, and we're deciding what to do next in our research. And these are the co-authors, 1995, and the title of our paper, Failure Prediction Evidence from Korea, was built during a period of high Korean macroeconomic growth. People were fat and happy in Korea in 1995. Korea had been growing at a GDP ratio of 10% or more a year for about a decade. But we were saying a lot of that growth is coming from artificial financing from banks which were subsidized by the government. And so there was this buildup, we felt, of a bubble in the credit markets. So why not try to build a model to predict financial distress of the most leveraged companies, et cetera? Based on data from 1990 to 1993, so an old one. And so we only had data on maybe 30-something, well, we'll see the sample size in a moment. But we felt that prudency was important. And the question was, what would the model look like, and would it be helpful for the future? Based on a sample of 33 distressed and 61 non-distressed companies, asset size between $13 and $300 million. And distress, well, you didn't have too many bankruptcies in Korea then, but you had liquidations and something called technical insolvency. And that's what we use to define distressed. Many of these companies had newly issued equity just since 1988. And we started out with 20 financial variables, and we ended up with 4. And here's the two models we built for Korea. So we have a Z Korea publicly owned firms, 4 variables: size, sales to assets, retained earnings, and that market equity to total liabilities. There are the coefficients, so if you want to take a photo of it and test it out, you can do it. And scores greater than 0.75 were in the safe zone, less than minus 0.23 were clearly in the bankrupt zone, and the article is published in the Journal of International Financial Management and Accounting in 1995. The second model, for private firms, in other words, not publicly traded, similar, only book equity instead of market equity, and similar cutoff scores. So these are the two Korean models that we built back in 1995. And the accuracy level was 96% 1 year prior, 85% 2 year, and after 2 years it wasn't very accurate. And the years of the bankruptcy had different accuracies as well. So the model seemed to be reasonably accurate. And here's Contingent shipping. Remember, any score in our model below 0 was classified as distressed, but certainly if you were below -2, you looked like firms that went bankrupt in the past. And Contingent shipping dropped in 2013 clearly below -2, and continued through 2015 way below -2. When did they finally go bankrupt? 3 weeks ago? 4 weeks ago? If nobody knows, it was 3 weeks ago. If somebody can tell me. And by the way, they filed for bankruptcy in the US, because the US has the most debtor-friendly bankruptcy laws. And the US is where many of the ships owned by them are sitting in Los Angeles Harbor today, full of freight, doing nothing but sitting there. It's a really sad situation. Anyway, they went bankrupt. The model clearly predicted it 2 or 3 years before. Now, there are 2 types of errors in these models. We call them type 1 and type 2. Type 1 is where you predict that a firm will not go bankrupt, but it does. You make a loan, but it defaults. You buy the equity, but it defaults. Very expensive. Type 2, you predict that a firm will go bankrupt, but it doesn't. Well, if you're an investor, not so bad. You don't make the investment and you put your money elsewhere. What are the applications of these models? The obvious one is for lenders to use in their lending function. Banks all now need models like this. Also, investors, perhaps investors in debt or equity. How about long-short investment strategies? Can you go short stocks here in Korea? Can you short? Yeah. So if you're betting that a company will go bankrupt, probably the average return is around 50% if you correctly predict a bankruptcy within 1 year. And if you have a portfolio of shorts and you're right, it could be very profitable. But the problem is, of course, short selling is quite risky. You have to pay the dividends, or if you short bonds, you have to pay the interest. So it's a very risky strategy. I don't recommend it. But certainly it can be used to select companies not to buy or to sell. Security analysts. Oh, by the way, long-short baskets. Goldman Sachs and Nomura both have investment strategies based on Z-scores. Go long the top 10% Z-scores of the S&P 500 and short the bottom. But you don't actually short, you buy long or short baskets put together by the investment banks. And they use Z-score as one of the criteria. Regulators, analysts, auditors. Any of you work for accounting firms? Well, accounting firms have to sign off on financial statements. And if they don't think a company will survive within 1 year, they give what's called a going concern qualification. I know it exists in Korea, just like in the US. Well, why not have a model to help you determine whether they should get a going concern qualification or not? Credit rating agencies, they'll never admit it, but I'm sure they have models. Sovereign default risk assessment. Let me spend 3 minutes on this application. And let me use Korea as the catalyst for this idea. So as I said before, I asked you, what country in all of Asia had the most vulnerable private sector in 1996? The answer was Korea. Second was Thailand, third was Indonesia. How did we determine that? Well, the World Bank took my model, I didn't do it myself, and calculated Z-scores for all listed companies in all Asian countries that they could get data. And then took the average Z-score and the distribution for each country. And Korea had the lowest average Z-score. Not because you weren't fairly profitable, but because of the huge amount of leverage. The average debt to equity ratio was 4 or 5 to 1 back then. I don't know what it is today, but it's much lower. So I remembered that 10 years later when Europe was going through a problem. And what we decided to do is recommend the building of probabilities of default based on the 75th percentile of companies in countries. What this means is 25% of the companies have a probability of default equal to this number. So, for example, the strongest countries were Ireland, UK, Sweden, Netherlands. And down at the bottom was Greece, Portugal, Spain, and Italy, with the highest PDs based on, it was not Z model, but it was a similar model called Z metrics, which we built for a consulting company called Risk Metrics. It's one of these hybrid models I was talking about, but the same idea. So in other words, to use the experience of Korea back in 1997-98 as an inspiration for a sovereign risk model based on the health of the private sector, here's the argument. If you have a healthy, low probability of default private sector, companies are more profitable, pay more taxes, hire more workers, the country is stronger. If you have a country where the companies have high default risk, they more than likely are not paying taxes, not hiring workers, and are not contributing to the health of the country. So we have built these models, and we have also made recommendations to central banks that they also use it to evaluate. The last one. How many of you work for real companies as opposed to financial companies or consulting? Companies that actually produce something. Raise your hand. What kind of company?
Refining.
Sorry?
Refining.
Refining.
Tech.
Tech. Anyone else? Real companies? Chemicals. How about anybody in the computer industry, technology, you said? Okay, real companies. Well, this application is really applicable for any company, but particularly companies that produce something. Managers. Let me give you the intuition without all the PowerPoint. And if anybody's interested, you can read about this company and this case study in some books that I've written. The idea is, if a model is accurate in predicting bankruptcy, maybe it could be used as a guide to avoid bankruptcy. In other words, whenever you have a company in trouble, suggest certain business strategy changes like selling assets, consolidating locations, paying back some debt, liquidating some unprofitable assets. But before you do anything, simulate the impact on the Z-score. It's like a sensitivity analysis. And I got this idea from a turnaround by a company called GTI, a technology company, also manufacturing high-tech products for the automotive, aerospace, and computer industry. And the company was in big trouble. It had been growing very fast, using a lot of debt, and then had problems in some of its major divisions. They called in one of their board of directors, and they elected a new CEO to replace the old one. And he happened to be someone who read about Z-scores. And he said, maybe that could be helpful. And he utilized the Z model in every major business decision he made over the next several years. Asking the question, what would happen if I made this business change to the score? And only doing it if the score would go up, moving the firm from the distress zone into the safe zone. And apparently it worked. So much so that there was an article written in a magazine about the turnaround strategy using a financial model. And the magazine called me up and said, Professor Altman, we are featuring this turnaround, and the CEO gives credit to your model in helping the turnaround. Would you read the article to make sure we have identified the model correctly? So I was very happy to read it, and sure enough, it was about this turnaround of this company using the strategy and the model. But this guy was a multi-millionaire, beautiful French wife, big yacht, sailing the Caribbean Sea with his wonderful family. So I said, I don't know if I really believe all this. So I decided to call up the company. Telephone operator picked up the line and said, good morning, GTI. I said, good morning. I would like to speak to someone who can tell me about your company. And she said, well, you should speak to the vice president of finance, who's also in charge of investor relations. I said, fine. She said, after a few seconds, oh, I'm sorry, he's on the telephone and will be with this call for quite some time. What exactly do you want to know? So I said, I want to know something about how the firm is doing, its management strategy, its mergers and acquisitions, etc. She said, you should speak to the president. I said, fine. How often do you call up a company and they want to put you straight through to the president? I said, well, who is the president? She said, it's Mr. LaFleur. I said, okay, I've been reading about him. I'd love to talk to him. She says, well, I'm sorry, he's not here. But if you give me your name and telephone number, I'm sure Mr. LaFleur will call you back. I said, okay. My name is Professor Ed Altman, and I teach at New York University. Dead silence on the phone. Did you ever call someone up, you know they're still there, but nothing? And after about 15 seconds of this embarrassing silence, the operator comes back on the line and said, oh my God, it's the Z-Man. This is the truth. She was frightened, upset. She thought that I was angry that they were using the model without asking my permission. I said, no, no, I'm happy you're using the model. Don't get me wrong. From the president down to the telephone operator, we're calculating Z-scores. I said, this is fantastic. But afterwards, I invited the president, CEO, to my university to speak to my students about how we use the model in a turnaround strategy. And to me, that was an application I never thought of. It's a true story, and I'm happy to tell you about it because, you know, it's nice to have that happen. The lady in the back has just held a sign that says, finish up, Altman. And so I would like to thank you very much for your patience to stay so late, and good luck in your careers. Thank you very much.
The World Knowledge Forum